Today, we are covering the essential topic of estimated tax requirements for individuals, a concept frequently tested on the enrolled agent exam. The foundational rule is straightforward. If you expect to owe at least $1,000 in tax for the year after subtracting your withholding and credits, you must make estimated tax payments. The exam will test your knowledge of how to avoid the underpayment penalty. This is done by meeting one of two safe harbor rules. The first safe harbor is paying at least 90% of the tax liability for the current year. The second, and more commonly used, safe harbor is paying at least 100% of the tax shown on the return for the immediately preceding tax year. The exam loves to trap test takers on an important exception to this 100% rule. If a taxpayer's prior year adjusted gross income, or AGI, was more than $150,000 or more than $75,000 if married filing separately, they must pay 110% of the prior year's tax liability to meet the safe harbor. Let's use an example. Suppose a client's AGI last year was $160,000 and their tax liability was $20,000. To avoid a penalty this year, they must pay at least 110% of that $20,000, which equals $22,000 through withholding or estimated payments. If their AGI was exactly $150,000, the 100% rule would still apply. The threshold is more than $150,000. These payments are typically made in 4 equal installments using Form 1040-ES. The due dates are a common point of confusion. They are April 15th, June 15th, September 15th, and January 15th of the next year. Notice they are not evenly spaced every 3 months. An exam question might give you a scenario with a self-employed individual who earns most of their income in the last half of the year. If they make 4 equal payments based on their total estimated income, they could face a penalty for underpaying in the first 2 quarters. This is where the annualized income method comes in. This method is calculated on Form 2210, underpayment of estimated tax. It allows the taxpayer to calculate their required payment for each period based on the income actually earned in that period. This avoids a penalty when income is received unevenly. The exam will expect you to know that this is the solution for taxpayers with fluctuating income streams, like freelancers or those with significant capital gains late in the year. To help you remember the safe harbor rules, use this phrase: pay 90 now or 100 from before, but if your AGI is more, it's 110 for sure. This simple line covers 90% of the current year, 100% of the prior year, and the critical 110% adjustment for higher income earners. Always check that prior year AGI first on any exam question involving estimated tax penalties.